Welcome to the Big Fat Real Estate Checks podcast with Marco Kozlowski, where we help investors like you get the knowledge and skills you need to replace your JOB with passive cash flow for life.
Hey everyone, welcome to Big Fat Real Estate Checks. I hope you're doing phenomenal. Every day above the ground is a great day, at least in my book. And today we're going to be discussing with Gabriel Araish how to make money in real estate, commercial, residential, your own home, and pretty much anything else that we want to shoot the shit about. If you're new to Big Fat Real Estate Checks, we're all about giving you as much value as possible. We believe it's your God-given right to be wealthy through the service of others. Just before we were shooting this podcast, I was discussing some properties that we're picking up on our side and what he's looking for on his side, and the opportunities that are available, and some news where big institutions are selling their assets at huge losses. And very interesting how many people, even banks, don't buy assets at the right number. They're not necessarily looking into the future, and we don't want that for you. So the two main things that we do is A, make you as much money as possible, and two, fold time, give you as much time as possible so you're not wasting time and getting the best result for the time that you put into something. And so let's get this ball rolling. So we were talking about a property in Chicago that Chase just offloaded for an $80 million loss.
$60 million loss. Yeah.
$60 million loss. Although for Chase, it's not a big deal. $60 million, right? They're massive institutions, so they can definitely take it on the chin. Maybe they needed the loss. Most likely not. Nobody likes to lose money. But
first rule of investing: don't lose money.
The first rule of investing is buy the stock at the right price, right? You got to buy. We're looking to buy value, right? And if you're not in the value business, you're going to be in a very dangerous business. We're looking at properties and how people are acquiring some of these multifamilies all over the country. Just a few years ago, at a 3% return, 4% return, 2% return, and expecting to improve the rents and refinance investors out. And how will you ever be able to do that if your return is at 5% and money costs 6%? Like, it's impossible. Like, you're really, really in a pickle. So we'll I know where the wind's going to take us. I know, Gabe, you're looking for a property of your own where you live now. You were living in Canada and moved your family down to USA. Very nice. And for your kids, so they could be in the right
environment,
right environment with the right coaches for the activities that they do. Very dedicated dad, which is why I love you so much. And so buying things correctly is really how to make money in real estate. Because if you don't buy it right, you're fucked. So let's talk about that.
All right, what do you want to start with? You want to start with the JP Morgan Chase?
Let's talk about that. Like, how many units? It's really bananas.
So JP Morgan, it's JP Morgan Asset Management, okay? Because I know that there's maybe some listeners out there that are maybe more sophisticated. Like, JP Morgan doesn't buy real estate. You're right. The JP Morgan Asset Management will buy the real estate, and they bought a building in 2016 in downtown Chicago for $140 million. It's a 198 unit multifamily. And they just
say that one more time.
That.
That's a big number.
198 units, and they paid $140 million in 2016. So remember, 2016 was pre-2020, obviously, and 2020 when the pandemic hit. We all know what happened to not interest rates, but the rental rates and the values of properties. So everything inflated big time, both the price of rent and the price of property in general. And again, this is multifamily. This isn't an office building that you expect to come down or whatnot. This is multifamily. So I think we want to maybe unpack a little bit more and just letting them know what the current average rental rate in here is. I don't know if you still have those figures in front of you, Marco.
So I actually don't, but let me pull it up. So I'm not talking out of my derriere here on the second. And these are current rents. So we're going to, if we look at the return that they've paid based on our loosey-goosey calculations on the asset, you're looking at around, for a one-bedroom in this building, let's call it $2,500 a month. For a one-bedroom, a two-bedroom, it would be going for approximately $3,500 a month. These are luxury assets, and a three-bedroom, on average, about $5,500 a month. And there's a handful of those. So if you take 35, two bedroom plus three, 2, 3, and 4. I'm sorry, 1, 2, and 3. Actually, there's probably one bedrooms as well. So let me pull that up. I don't think I did that one. Those are harder to rent, but also about 2,100. Let's call it 2,000. I'm going to go on the lower side. So 2,500, 3,500, 5,500. It's amazing how that extra bedroom really does make a difference. Obviously, you have to have a lot more space. Add those three together, and do a mean of that, an average, or four together. Do an average of that. You're probably looking at what, 3,500 or so. That'd be safe. 4,000. 3,500?
Yeah, 3,400.
Yeah. Let's call
Call
it
3,500 just to make it
just because
even more.
There's going to be some
more
extra revenue.
conservative.
Yeah, there's there's retail space also in the base of that. So I would add.
I don't know if there is for this building. It wasn't clear.
Okay, fair enough. So
Yeah,
let me do
looks
a
like
quick
it's just
check on that.
multifamily.
All right.
Yeah, so $3,500 a unit. There's 198 units. That's $693,000 a month.
Not a bad day at
And
the office.
8.3 million a year. This is if it's 100% occupied. So maybe do we want to actually act as if it is 100% occupied to show the
No. Let's call it 92%.
All right, 92%. It's $7.65 million in gross rent.
Okay.
So we're gonna assume what, that 40% expense ratio.
Sure. Yeah. Let's do that. Let's say. But yeah.
So
Yeah.
Well,
That's fair. They probably know
all
what
right.
they're doing. There's going to be a lot more. Who knows? Let's give them the benefit of the doubt. Sure.
Yeah. So at 60% of of gross income, they're keeping 4.59 million, call it $4.6 million as net operating income, which is basically what you're keeping in your pocket before you have to pay for any financing costs, mortgages, depreciation, amortization.
Yeah. There's no. You're right. There's no retail space on the bottom. I'm looking at that right now.
So it's 4.6 million before financing. Now let's assume JP Morgan paid it cash, so they're keeping 4.6 million, and they paid $140 million, but they paid $140 million in 20. This is a 3.28 cap rate, 3.29. Call it a 3.3 cap rate today. But the rentals that we've discussed are rentals of 2024. They are not the rentals at 2026. So presumably they were much lower when they picked it up. And also the value of the property, in theory, should have gone up, because we haven't mentioned what these guys just sold us for.
I'm looking right now, the rent increase from 2018 to 2024. And just to play the game on that, see if I can find that very quickly. Yeah, I'm going to be, I'm sorry. I was going to say something really smart while I'm doing this. No, there's a reason that we're doing this, right?
Yes. We just want to show you how even some of the major players in real estate don't necessarily always do the right thing. And buying right buying wrong was okay. It's not that it was okay. It looked okay because of an inflationary market. So if you bought something in 2005, 6, 7, and you overpaid for it, chances are you still look like a genius when you sold it in 2020. But if you bought something horrifically wrong, and then the market shifted where interest rates go up or rent rates come down or rent rates start stabilizing, all of a sudden your only opportunity to make money, which was the value of the building going up, that gets removed from the equation, and all of a sudden you're stuck with this thorn in your side. And this is what happened to, I still don't know. I can't tell you that this is what happened, but I can tell you that this is what seems to have happened, where they bought something for $140 million in 2016 and just offloaded it in 2024 for $80 million. So they took a $60 million loss
That's insane.
on the asset. It's more than insane. It's
Yep.
now we don't know what's going on there. Maybe this is a company shift where they're no longer keeping real estate or real estate in certain sectors or whatnot. There's always, there's always certain reasons why companies do things, and they're willing to take the hit because it's a one-time hit that they can, probably survive. But it's just an example of how even a large, well-known, well-funded company can make mistakes. And I mean, because even if they were going away from real estate this year, if they had bought this for what it was really worth at the time, they would have still been able to divest but make money in the process rather than lose money. And I'm pretty sure that they would have preferred that. So nothing changes. It's just that's we keep harping on this, that buying right is important, and yet there's all these examples of major players, whether it's JP Morgan Asset Management, whether it's your a local fund manager, or some of your friends who are syndicators, people that have been doing deals for 10 years. They're still, like I said, it's not because they did well that they're going to continue doing well, unless when they did well, they did it the right way, which is buying right and made money not just off. I mean, there was appreciation for everyone. So if they made money off appreciation, that's great. But if there were other things that they made money off, which is basically the equity that they've walked into when they bought it, those are the real professional investors. But the ones that basically made money because they held long enough, that's probably not going to be the case continuing forward.
So it's nuts how many people in the game, institutional investors, classes, seminars, YouTube videos, smoke signals, you name it. They all go through the mechanics of the acquisition, right? How to raise money, syndications, investors, and taking care of the investors. But no matter how good your intention is, if you buy it incorrectly, you're going to be fucked. And it's really interesting. As you said, Gabe, we don't know what the intention is behind things. Right. If you need capital to take care of an opportunity that's going to make you more money, you don't care about the loss, right? There are reasons why, as you said, we all do things. If I have an opportunity where I'm going to make 300% or have a chance to get in on the ground on an opportunity that I know is going to be a game changer, I just need that amount of money and I need to divest from whatever I have. And who cares? You get a capital loss, right? Mm-hmm. Now, I did on two sites. I got two different numbers, and I'm going to do the average of that. It's $2,600 on average for a $3,500 rent. So it's just under $2,500 and change. Difference. So $2,600, right? So it's $1,000 difference. It's actually $900 times. If you wanted to do the math again, it's probably easier. But 26.
So 25 is the average. 26 is the average.
Yeah, there was one that was 24. There was one that's 28, and
just call it 26 times 198 units times 12 times 0.92. We'll take the same vacancy of 8% divided by times a 40% expense ratio. So they bought this. It was making about $3.4 million. Again, we're reverse engineering this. It's probably not exact numbers, but it's going to give us a good indication. So $3.4 million is what they were making annually, and they decided to pay.
You did the 92%, right?
Yeah, I did.
Yep.
So that's a 2.45% cap rate.
But remember, at that time, I think
interest rates are low, right?
At zero or whatever, right? Now, here's the interesting thing: is if JP Morgan Management underwrites a loan on that, and then they obviously sell that loan, put that loan in a bundle, and actually make money on the sale of that loan. If you Watch The Big Short. There's an explanation on how that works, but
Yes.
there's money in bundling mortgages, and they most likely made some
Money.
coin on that, right? So at the end of the day, I don't know how much money they're going to lose, but they're going to show for sure a capital loss, right? So at times, the opportunity and the capital loss, meaning a break on taxes, is actually worth it. So again, we don't know what's going on behind the scenes, but it's very interesting that very large companies, from a consumer perspective, how we don't understand why would anyone sell something for an $80 million or $60 million loss. That's insane. But I'm sure there was a strategic move around it, and I'm sure that there's always a reason behind that thing. So
Yeah.
everyone has money problems. I want to talk about that for a second. You either have not enough money or you have too much money, right? It's one or the other. And if you have a lot of money, then there's capital preservation, where you're buying assets just to preserve capital, meaning that you don't care that it makes money or not. You're parking your cash, and as long as it's beating inflation, your money is protected with inflation. So you're basically buying and holding into assets that are stable, like multifamily.
But even if it's not beating inflation, again, like let's look at international investors. Say you live in China and there's, politically it's unstable, and you feel that your money's not safe there because they could come and take your property whenever they decide to, and you decide to, hey, you know what? The U.S. is more stable. Let me go buy a building over there, park my money there. Whether you lose money or not, a little bit left and right, that's not what it's about. It's about capital preservation, whereby if you decide to leave the country and then move to the U.S., you already have an asset and you have access to capital, which is something you may not have had.
Correct.
So again, that the reason behind why you're buying something is not going to be the same as anyone else, but you still have to make the best decision based on your investment objective. And it's not necessarily an investment, right? It could be just a purchase, even if it's real estate.
I know in Canada they imposed a tax, in Vancouver specifically, because real estate was really inflating because of all the money from Asia that was coming in to buy these assets. And
they stayed vacant. That's the problem.
They would buy it at exactly what you're speaking about is I want to move the capital in a way where if you're buying a property, it's allowed, right? So there's a lot of money that was transferred over, and these things are not being rented and really super
inflating the values of the house,
and very quickly, right? They put a $25,000 tax or 25% maybe. I can't remember. It was a while ago, but you might know more. I don't buy many properties in Canada, so actually don't buy that many at all. So even if the government imposes a tax, or you have to live there, or it has to be your primary residence, and you do have to move money, there's the reason to invest has to be aligned with the objective that you're trying to reach, right? So if your objective is to buy an asset for capital preservation, moving capital in a way where you're going to also preserve your capital, but just out of the country, so it's you have an asset there without worrying about moving capital where where you are is unstable. We also buy. At first, you just want to buy something, so you have proof of concept, right? Remember, you just want to buy your first deal, period, right? You remember that, Gabe? And you bought things wrong as well, right?
100%.
I guess I'm lucky in that I didn't have money or credit, so I wasn't allowed to buy things wrong because I didn't have money and I didn't have credit, and I had to rely on sources that made me buy property at the box that I was put in with those boundaries. So then you go to cash, and then once you have cash, you're like, well, wait, now I don't want cash anymore, because as soon as you have cash, it disappears. It's feast and famine, feast and famine, feast and famine. Then you want to focus on cash flow. And then as you start building your assets in cash flow, now you have a new money problem, which is taxes. And there's always an issue with something as we go down the road. And real estate is a vehicle where you can, even if you overpaid on purpose for a reason to get a capital loss later, which I know doesn't make any sense if you're struggling paycheck to paycheck, and like, why would anyone do that? Well, if you have for example, a partner that you want to pay off, and you want to show a capital loss, there's a strategy there where you can actually take care of your partner and get a capital loss by buying it through a different asset, so different LLC. So I don't want to get too down the rabbit hole, and I think I'm just going to remove that because I'm just going to confuse people with that process. So I'm just going to go like this and remove that completely. So understanding your reason or your objective is going to be very important, because when it comes to your own personal residence, you can actually break all the rules because this is where you live, right? This is where you're going to nest. Within reason, at least for me, like I can't buy anything retail. Like it's almost against my religion, right? I can't, I find it very difficult to buy an asset that's like a piece of real estate, a car, something that is negotiable, right? I want to get value because a penny saved is a penny earned, right? And it's a lot easier to spend money in most cases than to make money. So Gabe and I were discussing how should we approach, buying your own property? Should you pay retail? Is it okay to pay retail? Should you not pay retail and not have a place to live? Like there's a sacrifice that has to be made somewhere based on your
Correct.
objective, right? So
Yeah.
we can dip our toe into that pond for a minute. If you
Sure.
want. Yeah.
I mean, we could use my example. I'm
Yeah.
looking for a home. I mean, I'm educated enough now that I like to get I like to get into equity or step into equity in any real estate deal I make, including my home. But, where I live right now, a lot of the homes are, have inflated like everywhere else, but they're not deflating at the speed that they're deflating in other parts of Florida. And for the most part, a large percentage of people who buy homes in my area also buy everything in cash. So having a debt in place that I might want to step into, which is, one of the strategies that we've spoken about, where if someone has a 3% loan because they bought the house in 2021 and you want to keep that in place and just give them the cash difference between their mortgage then and what the value of the house is or what the agreed upon purchase price is now, that would make sense because I'd have a payment of 3% and I can just pay them in cash for the difference. But even that is getting harder and harder to find in my zip code, for example, just because most people are buying their homes cash. And, there's been an influx of people coming in from New York post-pandemic. They're selling their condos, 2,000 square foot condo for like whatever, $5-6 million. Yeah. And then they're coming in here and getting 5,000-6,000 square feet of, a big one floor home for $2.5-3 million. They're buying everything in cash. They don't care. And they don't care about overpaying for something because they're buying based on what they need, which is I want to live here and I want to live here now. And if you have the money, God bless you. Nobody's going to tell you you're doing the wrong thing. But that also inflates prices. And when these people want to sell, they don't necessarily want to take a loss. They feel like they should get at least what they paid for. And so, I'm always in this dilemma. And, Marco and I speak a lot about this. But this is my home. This is where I want to raise my children. This is where my wife and I are going to make memories. This is, it's an emotional purchase as much as it is an investment. And the idea is to stay here 20 plus years. So whether I pay retail, below retail, or above retail, in the end, I have no access to that capital because it's going to be stuck there for a while. I may eventually, if there's no mortgage on it, kind of refinance and cash out a little bit of it. But I'm just saying in the first 5 years, 6 years, where we normally would refi a property when you buy it right and get most of your money out, that's not going to happen in this situation. And so, I think I'm at the point where I kind of understand that if I want to go down the road of, waiting to create a deal in my area, in this environment, I either may wait very long or it may never happen. I don't know. But if I want to make sure that things stay happy at the house, then I may have to move a little bit faster and kind of pay closer to retail on something.
Well, happy wife, happy life, right?
100%, and things couldn't be truer.
Right. Now, the beauty of I think we already have a podcast on this, but maybe we'll have to do another one. Is if you find a $3 million property with a $2.5 million loan and they want $100,000 to bail, for example. All right, so you have a $100,000 down payment on a $2.6 million property, a $3 million property, right? And that's not a huge discount, at least in our world, right? So that's
No.
pretty close to retail. To me, that's overpaying, but if it's your own home, that's fine. All right, just different experience, different perspective. Now, if I really wanted the home and if they didn't get $3 million, they would tell me to, screw myself. And I loved it. I'd probably have to do it because it was something that I want to live in. Right. And, it would be based on an emotional decision. But at the end of the day, if there's a big difference on the payment that has to be made versus the value of the home itself, because there is value in taking over a cheap mortgage. Because if you're stepping into a $2.5 million loan at 1.5%, which we see all the time, or you're stepping into what we saw today at a 10.5% mortgage, that's a completely different payment, right?
Yep.
If you're overpaying at 2% and you're paying 20% off at 11 or 12%, which one would you prefer if it's your own home, right? And cash flow is king, but also cash outgo is what you really have to look at the end of the day, not necessarily what you're paying, right? So I have no problem paying $10 million for something that's actually worth $3 million if there's no payments for 100 years, right? Who cares?
Yeah.
Right? It's how do I monetize the situation? Because at the end of the day, it's not the gross that matters, it's the net, right? Mm-hmm. And so can you overpay for your property? Well, it depends on your wife or spouse, right? Is it something that you can afford? You don't want to necessarily go into something that's going to necessarily hurt you either. Yeah. But don't necessarily look at the purchase price. Yeah. I think the payment is really something that you also have to look at. But be careful, because that's how car dealerships get you. Now, car's a depreciating asset. It's not the same thing, right? This is actually going to be a different podcast, because I think it's quite interesting in that you are asked what payment do you want to pay. They give you this low payment, but you actually owe more on the car later than it's worth, and you're upside down, right? Very, very interesting, and how actually Canadians are really screwed on mortgages on that. But that's it.
Oh my God,
it's a conversation for another day. So to wrap this up, Gabe, my ADHD is going bananas. So I'm really glad you're here. So to wrap this up, give us three hot points to remember based on what we've discussed.
All right. Well, one, if you're buying an investment property and your objective is to make money, buying the property at the right price, which is generally at a fair discount, I want to say at least 20 to 30% off, is going to be the way to go. I think it's non-negotiable, at least when we're investing. Two, this is another thing. You might make sure you know what your exit strategy is when you're investing. So if you're going to sell a property or refinance it, and when I say exit, I mean, how are you going to get the money back that you've invested? Whether it's your money, whether it's investor money, whether it's money or mortgage money, how are you going to get that back?
That's a great topic.
You have to figure that out before you actually buy the property.
Know your exits. Know your exits before you enter. Like firemen won't go into a burning building unless they know there's another exit.
Or they know how to get out. Yeah.
They have to know how to get out before they get in, and that's the same thing. And a lot of people got in and have no idea how they're going to get out, which is nuts.
Well, and that's it. Maybe they did know how to get out at the time, but then shit hit the fan, but they only had one exit. So maybe it's understand if there's multiple exits. That's the other thing, right?
But shit didn't hit the fan. It's just the cycle that everyone It's so funny how we have such short memories. Everybody knows every 8 to 12 years there's a crash, right? It's just all the time, and we're due. That's it. And you're so focused on it's not going to happen, and it always does. And that's the difference, I guess, in what we do is if you buy it right, if there's a shift, we're fine because we already bought it right? Everyone's fine. That's the point. Anyway, sorry to interrupt you.
And the third point is, when you're buying residential for yourself as a home, then paying retail or above retail even could be a possibility. The one thing you need to make sure is that you can afford the payments. It's not going to hurt you. So don't basically, if you make $10,000 a month as a family, and this house is going to cost you $8,000 a month, then that's your first signal that maybe it's not the right house. It doesn't matter, even if you're getting at a major discount, you can't afford this house, because $2,000 to feed your family and then be able to have some sort of lifestyle is not going to happen. So understand what you can pay for a home, and then work with that payment, if you will. But just be careful. But it's one of those places where, yes, when you're buying something for things other than an investment, whether it's emotional, whether it's because it's a family home, whatever other reason, then yes, I guess you could pay retail, but it's always better to get a discount, like everything else.
Or get a discount in some way, meaning either taking over an existing mortgage that is discounted, because that counts, right?
Yeah.
So, and if you're overpaying, again, make sure that whatever you're purchasing is adding value to your lifestyle. I think that's the real message at the end of the day. Is it adding value to the direction that you want to take? So is there value in putting money in, if you have a lot of cash, to put it into here and know you might lose money if something happens? And if there's value to that for you, then that's the right direction. Is there value in taking over this mortgage? And if you didn't know this, but all mortgages can be taken over if you know what you're doing, right? All mortgages, legally, morally, ethically. So, and if that is adding value to cash flow, or adding value as a tax deduction, adding value as a capital preservation, whatever investor, investor returns, whatever. If there's value there, then good. And if you're not stepping into value, you got to pay attention to why you're doing it to begin with. Are you getting a deal just to get a deal? Because that's an ego buy, not a value buy. And if you don't have a value buy, you're going to go bye-bye very quickly.
Oh, yeah.
Yeah. And it's sad how many people are not buying value. They're just trying to add value without buying into value, which is, you have to. There's got to be some value there. So
correct.
There you go. So Gabe, thanks very much for your insight. Sorry, listener, ADHD today a little bit. So, but you know what? We're here because we really want to serve you as a listener, and we really want to help just give you some insight. There might be one little thing that we say that sparks the spark that you need to really propulse yourself and your family into a direction that really completely changes the trajectory of your financial future in life. That's how things work. You have an idea, it grows, it grows roots, and suddenly you have an oak tree. And that's what we're here for. So really appreciate you very much. And like us, love us, share us, make sure you subscribe. And if you're starting at this episode, go back to episode 1. And really great content throughout. And I'm really excited to have you listening into what we do and how we do it. And can't wait to see you on the next episode. Thanks so much. And just love life. Thanks, guys. Appreciate you. See you next time.
If you like this episode of Big Fat Real Estate Checks, then show some love by leaving a comment and a good rating. Also, as a thank you for tuning in today, we've got a special free gift. The journey to passive cash flow for a life starts by finding deals, and it's easier than you think. Simply go to getdealsbytuesday.com, enter your email address, and we'll send you a free quick start course called Deals by Tuesday. Even if it's 11 p.m. Monday night, this course will show you how to find discounted real estate deals by Tuesday. It's that fast and simple. Go to getdealsbytuesday.com and start your journey toward life-changing cash flow today. Thanks for tuning in, and we'll see you on the next episode.